Plug Power Inc. is currently trading at $2.26, reflecting a gain of 7.11% as markets respond to the latest earnings results. While the broader market sentiment often paints this stock as a high-risk gamble, the reality unfolding in the recent quarterly report suggests that the company is effectively trimming the fat from its operations. Investors have spent months bracing for bad news, assuming that cash burn would continue to spiral out of control. But the reality is that the company reduced its cash usage by 58% sequentially in the second quarter. This is the kind of operational pivot that forces a serious reevaluation of the stock. For those who utilize Fidelity Investments to manage their retirement, or those who prefer the interface of SoFi Invest for active trading, the movement in Plug Power represents a classic case of expectation versus reality. The prevailing narrative suggested that the hydrogen industry was stalling, yet Plug Power just reported revenue of $178.3 million, beating analyst expectations and proving that their commercial engine is actually gaining momentum. When you look at the landscape of online investing, it is easy to get caught up in the noise of daily fluctuations, but a clear-eyed look at the numbers shows that gross margins are swinging from deep negative territory toward break-even. This is not just a statistical anomaly, it is a direct result of aggressive cost-cutting and improved manufacturing efficiency. Whether you are using individual brokerage accounts or checking your holdings on the Robinhood app, the signal here is distinct. The company is managing its way through a difficult environment, and the market is slowly starting to recognize the progress. If you are an investor who favors Interactive Brokers for its robust trading platform, you likely pay close attention to liquidity ratios and burn rates. For a long time, the expectation was that Plug Power would face an unavoidable liquidity crisis. The reality is that while the cash position remains lean, management is actively executing asset monetization strategies, having already secured capital through recent transactions. This is where the difference between amateur and professional analysis lies. Many investors focus solely on the share price, ignoring the underlying shifts in capital efficiency. The company's ability to pull in revenue from its electrolyzer business is no longer just a promise for the future. It is a tangible part of their current revenue stream, with massive projects like the one in Portugal and the newly announced order in Australia illustrating that they are effectively securing large-scale industrial contracts. For those who use Fidelity mobile app or track trends across various investing sites, the contrast between the skepticism surrounding hydrogen technology and the actual order flow should be telling. The stock has been beaten down significantly, sitting far below its yearly highs, which means the current valuation is essentially pricing in a pessimistic outlook that the latest financial data is beginning to contradict. When you weigh these factors, you have to ask yourself whether the market is reacting to the past or anticipating the future. The expectation was that Plug Power would struggle to maintain its growth trajectory in a high interest rate environment. The reality is that they have successfully cut operating expenses by 50% year over year, which is a massive achievement for a company of this size. This is not a company just hoping for a miracle. It is a company that is systematically rebuilding their internal cost structure. If you are comparing your portfolio holdings, perhaps even looking at Tesla stock or Nvidia stock alongside your energy sector exposure, you might wonder why hydrogen keeps coming up in the conversation. It's because the transition to clean energy isn't a single event, but a series of industrial shifts. While platforms like Schwab Intelligent Portfolios or other robo-advisory tools might not be giving this stock a high allocation, active traders using the SoFi trading platform have been watching the volume spikes closely. The volume we are seeing suggests institutional interest is returning, which usually precedes a sustained change in price action. The volatility of the last few months has cleared out many of the weaker hands, leaving behind investors who are more focused on the long-term potential of the hydrogen economy. Comment below how many shares of Plug Power Inc. you currently hold, or if you were waiting for a more stable technical setup before adding to your position. It's interesting to watch how different platforms like Robinhood stock trading or Interactive Brokers trading handle these periods of heightened activity. When a stock moves this much on earnings, it often signals a change in the dominant sentiment. The bear case has long been rooted in the company's inability to turn a profit, but the path to positive EBITDA in the fourth fourth quarter is becoming clearer with every efficiency gain. If you are looking for investment help, remember that the most successful strategies often involve ignoring the daily panic and focusing on whether the company's business model is actually delivering on its promises. The electrolyzer business in particular is proving to be a catalyst that many analysts underestimated. When you have a massive opportunity funnel, estimated at around $8 billion, the conversion of those leads into revenue becomes the primary metric of success. The market is currently in a show-me phase with this stock, and the latest earnings report has provided exactly the kind of evidence that institutional investors look for before committing larger sums of capital. For those using Fidelity ETFs or Fidelity mutual funds to balance their risk, adding a company like this can feel like an outlier, yet the scale of the hydrogen market suggests that it cannot be ignored forever. The quote-unquote energy transition is often talked about in abstract terms, but companies like Plug Power are building the actual infrastructure to make it happen. The reality of their cost improvements shows that they are moving from a prototype phase to a mass production phase. This is the hardest part for any industrial company, and the fact that they are hitting these milestones while managing a tight cash position is commendable. If you are using the Fidelity brokerage to trade, consider how much of the current stock price is sentiment-driven versus data-driven. The earnings beat was not massive in absolute dollar terms, but the margin recovery was substantial enough to alter the narrative. The expectation for a larger loss per share didn't materialize, and that gap between expectation and reality is exactly where the value is being found right now. This is a classic setup for a stock that has been unfairly punished and is now showing signs of stabilization. The future outlook for Plug Power centers on the successful execution of these upcoming projects. The catalysts are clear: continued margin expansion, progress on the DOE loan, and further growth in the electrolyzer order book. If these materialize, the stock could see a significant re-rating over the next few quarters. However, the risks remain. The hydrogen industry is capital-intensive, and any failure to secure necessary funding or delays in project commissioning would weigh heavily on the share price. Investors should be prepared for continued volatility as the company navigates this transition period. The difference between success and failure here will come down to management's ability to maintain discipline in their capital allocation. While the company still has a long road to profitability, the progress made in the last 2 quarters is undeniable. When using tools for online investing, it is crucial to stay updated with the latest SEC filings and company updates, as this is a fast-moving space. The recent shift in management's guidance to 15 to 16% revenue growth is a signal that they have a high degree of confidence in their current pipeline. Whether this confidence is justified will be proven by the performance in the second half of the year. As we look ahead, the interplay between policy support, industrial adoption, and internal operational efficiency will dictate the stock's path. Many who participate in Robinhood crypto or Robinhood fractional shares trading often look for high-growth sectors, and hydrogen certainly fits that bill, though it carries a higher risk profile than more established blue-chip equities. The focus on service revenue, which saw a 27% margin, is particularly encouraging. It shows that the company is not just selling hardware, but creating a recurring service business model that will eventually provide a more stable foundation for their financial results. For those managing their own investments, understanding the shift from hardware-heavy revenue to services-heavy revenue is a critical analytical skill. This transition is usually what separates mid-cap winners from those that fade away. The company's goal of reaching operating income profitability by 2027 is a bold target, but the current trajectory of their expenses suggests it is a goal that is at least within the realm of possibility. If you are comparing your portfolio holdings, perhaps even looking at Tesla stock or Nvidia stock alongside your energy sector exposure, you might wonder why hydrogen keeps coming up in the conversation. It's because the transition to clean energy isn't a single event, but a series of industrial shifts. While platforms like Schwab Intelligent Portfolios or other robo-advisory tools might not be giving giving this stock a high allocation, active traders using the SoFi trading platform have been watching the volume spikes closely. The volume we are seeing suggests institutional interest is returning, which usually precedes a sustained change in price action. The volatility of the last few months has cleared out many of the weaker hands, leaving behind investors who are more focused on the long-term potential of the hydrogen economy. In summary, the story of Plug Power is one of transition and incremental progress. While the stock has faced extreme pressure and negative sentiment for quite some time, the recent earnings report provides a concrete foundation for a potential recovery. Expectations were low, and the reality, while not perfect, exceeded those low bars by a wide margin. The company is actively solving its biggest issues, cash burn and negative margins, and the market is beginning to notice. Whether this is the start of a long-term turnaround or a temporary bounce remains to be seen, but the data points to a company that is far more operational than it was even a year ago. For those who invest online, the key is to avoid the emotional swings of the daily price action and focus on the cold, hard numbers being released in their financial reports. The company has a clear path forward, and the execution in the coming months will be the ultimate